Hello, everybody! Welcome to the world of common stock. Today, we will be learning about its characteristics, valuation, and issuance. What is common stock? It is a residual form of ownership in that the claims of common stockholders on the firm's earnings and assets are considered only after the claims of governments, debt holders, and preferred stockholders have been met. So in every liquidation of a company, the common stock is considered the residual form of ownership because the stockholders who bought or owns a common stock will only have their claims once all of the debts have been settled from the government to the debtors and to their preferred stockholders percentage. For example, the company announced a public offering of 3.5 million shares of common stock. And if none of these shares are, for example, newly issued, sold, or repurchased, which will be called treasury stock, then the accounting records are not affected when there is a transaction of or no transaction as such in the common stock. The corporation will go about its routine business operations without even noticing that there were some changes among its stockholders. And when the investor buys a common stock from the company who announced the public offering of 3.5 million shares, then they will give money in exchange for a part ownership. And the corporation issues here a certificate or digital record of ownership interest to the stockholders. And this certificate is known as a stock certificate, capital stock, or stock. Common stock is considered a permanent form of long-term financing because unlike debt and preferred stock, common stock has no maturity date, and it has no maturity date because the common stockholder has an ownership interest in the corporation. It is not a creditor nor a lender. Hence, the common stock does not due or mature. So other terms of common stock: common share, ordinary share, and voting share. Now, where can we find the common stock in the balance sheet of a company? Of course, we can find it in their shareholders' equity together with the paid in capital, retained earnings, preferred stock, and also treasury stock. And what is its default entry? It is credit. Now we have here an example of a stockholder's equity. We can see here the preferred stock listed, common stock, $2 par value, authorized 10 million shares, issued and outstanding 6.675 million shares. So what do you mean by issued and outstanding shares? This means that the total amount of shares issued to the stockholders and at the same time currently held by the stockholders. So this is the total amount for that. We have here also listed the contributed capital in excess of par value. This is the premium, the retained earnings, the total earnings of the company with the total. So this is now the total stockholders equity, which is 117 and 820. So we will be learning on how to compute the book value per share with the formula total common stockholders equity over the number of shares outstanding. But before that, I just want to discuss what's the difference between the book value with the market value. So when we say book value, it is found in the balance sheet of the company, and it is roughly equal to the total amount that the shareholders would get if they liquidated the company, while the market value is the company's worth based on the total value of its outstanding shares in the market, which is its market capitalization. Okay, going back. Book value per share. How to compute the total common stockholders' equity? Of course, this is not the one. This is not 13,350, but we will get it by the total stockholders' equity, and we'll just deduct the preferred stock here in this example. So we will deduct 37,500 with 117,820 million, and we will get these figures: $80,320,000. So here we have now the total common stockholders equity. And how much is the number of shares outstanding? Of course, we will not get it from the preferred stock because we are calculating here the common stock. So the common stock number of shares outstanding, or the number of shares currently held by the stockholders, is of course 6,675,000 shares. Um, we will not be discussing further about this, but just want to note that the number of outstanding shares will be affected if there will be treasury stocks or there will be repurchases. So we'll have to deduct it in case we will have repurchases. So the book value per share on this example is $12.03. So if you will buy a stock, of course, you will be called a stockholder. Now, as a stockholder, you can exercise your rights, and we have here several general rights. First, dividend rights. So what is a dividend? This is the sum of money paid or the profit, of course. Dividend rights is a right to share equally on a per-share basis in any distribution of corporate earnings in the form of dividend. So it could be a cash dividend, a stock dividend. Next right is assets right. So right to assets that remain after, meaning residual, after the obligations to the government, like taxes, employees, and debt holders have been satisfied. So you will have the right to the remaining assets if there will be any after the liquidation. Next, preemptive rights. The right to share proportionately in any new stock sold. So preemptive rights, this is just like you will have the right to know if there will be like new issued stock. You will be given a heads up so that you can decide if you wanted to buy or not to buy the new issued stocks, or I mean newly authorized stocks. For example, here, a stockholder who owns 20% of a corporation's stock may be entitled to purchase 20% of any new issue because, for example, if you wanted to maintain a 20% share of the total amount of stocks that the company authorized, then to maintain that, of course, when there are new issued stocks, you should buy it to maintain your significant uh, significant influence in the company. The last stockholder right is the voting right. So this stockholder right, you will only have a voting right, of course, if you bought a common stock that has a voting power, because there are also common stock which is non-voting. So this is only applicable to those common stock with voting rights. This is the right to vote on stockholders' matters, such as the selection of the board of directors. There are other features of common stock. First is the common stock classes, meaning to create more than one class of common stock. Like Class A common stock is non-voting, or Class B common stock has voting rights, like my example earlier. So let's take Ford Motor Company, wherein they have a 40-60 ratio, meaning 40% is owned by the family of Ford and 60% is issued to the public or is held by other shareholders, which can be Class A, non-voting, or Class B with voting rights. The reason for this, in creating more than one class of common stock, is if the firm wishes to raise additional equity capital by selling a portion of the existing owner's stock while maintaining control of the firm. So they wanted to raise additional equity while maintaining the control. So this is the best way to handle, to create more than one class of common stock. Other features of common stock. Second, stock splits. A stock split is a decision made by the company's board of directors to split the existing number of shares outstanding to increase the number of shares outstanding in the market. This is done instead of issuing new shares of stock. So stock split does not dilute the percentage of ownership by any shareholders. The existing shares are simply split. The goal of the company or the board of directors, of course, is to maximize the value of their shareholders. And if on their estimation, the price of each share of stock is becoming too expensive, or other investors are not able to invest more because they cannot afford it anymore. So they may decide to do a stock split if needed. So one common reason is that, again, if the stock price has risen so high, and they could limit the upside price potential of the stock. Now, for Google, we all know that Google is a very successful company. And it is expected that, of course, their stock price will be very expensive also. So by that, Google implemented 20-for-1 stock split. So from $2,200 per share now, it comes to $113 per share. See, when a stockholder or when an investor knows that they are selling 113 per share, of course, they will be inclined to buy shares with Google, and it can increase now the capital equity of Google, and at the same time the investors can now own part of the ownership by Google. So the other features, that's for the stock split. So the other feature is reverse stock split. Of course, it is just the opposite of stock split. So if stock split is to multiply or to increase the number of shares outstanding in the market, for reverse stock splits, it decreases the number of shares outstanding in the market by canceling the current shares and issuing fewer new shares based on a predetermined ratio. So the primary reason again for reverse stock split is, first, to meet the requirements to be listed on a major stock exchange. So in every major stock exchange, like for example here in the Philippines, which we call Philippine Stock Exchange, there is a minimum amount for a company to be listed on their major exchange. And if you will not be able to meet the minimum amount of requirement, then the company will be delisted. And if a company will be delisted, you will not be able to participate in any significant or major exchanges. So it can also affect your financial position in your company. So nobody would like to be delisted in PSE. That's why if uh, your stock price is getting lower, then the other option that you can do to survive in the market is to do a reverse stock split. For example, here in Motorola Mobility Holdings common stock, Motorola Incorporated, completed a 147 reverse stock split. So in every 7 stocks that you own, it will now be equivalent to 1. And doing that, the per share, the amount per share of your stock will increase. And now the company can attain their goal in increasing their per stock or per stock per price and be listed, still be listed in Philippine Stock Exchange. Now, how about if a shareholder or a stockholder doesn't own more than 7 stocks in the company? So these investors can be cashed out of their positions if they own a small number of shares, meaning they will be paid with the percentage, equivalent percentage on your stocks owned. So if 1 for 7 and you only have like 6 stocks, you can either buy an additional stock or you can choose to cash out your position equivalent to the percentage, which is 6 over 7 equals to around 85% of the per share. So that's it. The fourth common feature of a common stock is stock dividends. So as I've mentioned earlier, dividend is the distribution of a company earnings. So for stock dividends, it is a dividend to stockholders that consists of additional shares of stock instead of cash. So if a company doesn't want to release earnings in a form of cash, then they can release stock dividends to increase or to add the outstanding shares of their stockholders. For the fifth one, stock repurchases, or what we call treasury stocks, refers to previously outstanding stock that is bought back from stockholders by the issuing company. The result is that the total number of outstanding shares on the open market decreases. These shares are issued but no longer outstanding and are not included in the distribution of dividends or the calculations of earnings per share. So if you can remember, I've mentioned earlier that treasury stocks should be deducted on the total outstanding shares of the common stock. Why? Because when you say treasury stocks, for example, the company will issue or authorize 10,000 shares to the public. Then the public will buy from that company. For example, let's say 9,000 shares was issued and outstanding. So these 9,000 shares are now owned by the public. And if the company will decide to buy back that share from the shareholder, then that will now be called the treasury stock. And treasury stock is not outstanding anymore because it is already in the hands of the company by the time they bought it back. And you must also take note that it is not included in the distribution of dividends, of course, because they own it now. And the calculations of earnings per share, it will not also be included. That's why we will deduct it. All right. So for the first advantage of common stock, there is no fixed dividend obligation exists. So it is more flexible. What do you mean by no fixed dividend obligation exists? The company will not be entitled to release or give dividends to its shareholders. So it just depends on the discretion of the board of directors if they feel like they wanted to release cash or stock dividends. But it is really not that mandatory, so it is deemed as flexible. Of course, it is less risky to the firm. Why? Because there is a greater degree of flexibility in their financial plans, so they can adjust whenever needed. And it can lower the firm's weighted cost of capital. So for the disadvantages, it can dilute the original owner's claims on the firm's earnings. As I've mentioned earlier, if you wanted to maintain a 20% ownership of the company to gain a significant influence, so in every new issuance of shares, then you will be entitled for the preemptive rights. But in order to also maintain that, you need to buy and buy whenever there is a new issued shares that is equal to 20%. Because if not, it will decrease your percentage ownership. So it can dilute your claims. The second disadvantage, it involves relatively high issuance costs associated with common stock sold to the public. So it is costly because there are a lot of other issuances costs. In addition to the direct cost of underpricing or of issuing common stocks, you need to pay for the management time in preparing the offering. The cost of stock price declines for seasoned offerings, or the cost of other incentives provided to the investment banker. Now let's come to the valuation of common stock. In principle, the valuation of common stock is no different from the valuation of other types of securities, such as bonds and preferred stock. The basic procedure involves capitalizing, that is discounting, so we will be getting the present value factor, from the expected stream of cash flows to be received from holding the common stock. So there are a lot of ways to value your common stock, but I'm going to discuss only three. First is a one period dividend valuation model. The second is the multiple period dividend valuation model. And the third is the zero growth dividend valuation model. Okay, so one period dividend valuation model. The formula for that is PO, which is the initial value of stock is equals to the dividend D1 over 1 plus KE. So KE here is the rate of return plus P1. P1 here is the amount of the common stock at the end of one period over 1 plus KE. So for one period, this means that the investor only plans to hold the common stock for only one period. Let's say, for example, here, Ohio Engineering Company common stock is expected to pay $1 dividend and sell for $27.50 at the end of one period. What is the value of this stock to an investor who requires a 14% rate of return? So the answer is computed as follows, given the formula. PO is equals to 1, which is D1, the dividend, over 1 plus the rate of return, 14%, so it's 0.14. And since it's only one period, we'll just have 1 there, so we can just not show it because it's automatically understood, plus $27.50. This is given. The amount to sell at the end of one period over 1 plus 0.14. So we will get $25 by calculating that. Where did we get the present value factor? 0.14 is to 1. 0.14 is to 1 period. So we just got it by 1 over 1 plus 0.14. So that will result to 0.877 because that is the present value factor. Then we'll just multiply it to 1. Why is it multiplication when it is division here? Of course, because 1.141, it is deemed as 1 over 1 plus 0.14. So if that case, if you're dividing twice, then you'll have to multiply it na. So same here, same goes to here. 27.5 times the present value factor of 0.877, we will now arrive to $25. So the investor who purchases a stock of $25 collects the one dividend and sells the stock for $27.50 at the end of one period, who will be earning the 14% required rate of return. Next is the multiple period dividend valuation model. So the difference is, if we have discussed the one period, this will now include multiple period of holding the common stock. So let's consider again the Ohio Engineering Company common stock. Suppose that the investor is considering purchasing a share of this stock and holding it for 5 years. Assume that the investor's required rate of return is still 14%. Dividends from the stock are expected to be $1 in the first year, $1 in the second year, $1 in the third year, $1.25 in the fourth year, and $1.25 in the fifth year. So the expected selling price of the stock at the end of 5 years is $41. So with this given formula, we'll just have to add all the dividends per year, same with the uh, formula we have previously. It's just that it only involves one period, plus the selling price at the end of the 5 years. So the calculation would be as follows. 1 times the present value factor. I've already discussed why it's multiplication. And let's just add it. 1 times the present value factor plus $1 times the present value of the third year plus 1.25 multiplied by the present value factor of the fourth year plus $1.25 multiplied by the present value of the fifth year plus $41 multiplied by the present value of the fifth year, of course, with the 14% rate of return. So this will now be the calculation, 0.877 for the first year present value. For the second year, we'll get 0.769. Third year, 0.675. For the fourth year, 0.592. Fifth year, 0.519. And fifth year, the same with this one of 0.519 multiplied by $41. And we will get the same answer of $25 or 24.99. Please note that the current value of a share of Ohio Engineering common stock is the same. That is the initial price, PO, is equals to $25, regardless of whether the investor plans to hold it for 1, 5, or any other number of years. What if there will be no growth on the dividend? So we will be using this model, zero growth dividend valuation model, with this formula. PO, again, the initial stock price is equals to the dividend over the rate of return. So the general dividend valuation model can be simplified if a firm's dividend payments over the time are expected to follow one of the several different patterns, including zero growth, constant growth, and non-constant growth. So when we say zero growth dividend model, there will be a constant release amount of the dividends within a determined future time. So assume that the Mountaineer Railroad common stock pays an annual dividend of $1.50 per share, which is expected to remain constant for the foreseeable future. What is the value of the stock to an investor who requires a 12% rate of return, substituting 1.50 for D and 12% for KE? So just simple as it is, very straightforward. We'll just have to divide the dividend 1.50 over the rate of return 12%, so it's 0.12. We will now get 12.5 as the value of the stock on the initial term. So I think that's all, guys. Thank you so much for listening. And if you have any questions, just let me know and I'll answer it as possible as I can. Again, a sweet thank you. Have a good one.